Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from. The Hashi covers what you need to know about the real estate industry in a 24-hour time period. On today's Hashi, I will discuss the debt deal vote, Powell's next move, and how many U.S. housing markets are overvalued today. Today is Thursday, June 1st, 2023. I am Byron Lazine, and the Hot Sheet starts now. Welcome back to the Hot Sheet and welcome to June. Here we go. We've got 7 months left of 2023. Hit the thumbs up. Glad to have you back here. And I'm glad to see that we have the debt deal drama potentially behind us. Debt ceiling. House approves deal struck by Biden and McCarthy. The House passed a sweeping bill that suspends the federal government's $31.4 trillion debt ceiling in exchange for spending cuts, as Republican Speaker Kevin McCarthy muscled through a deal struck with President Biden to avert a looming government default. It still has to pass through the Senate. Okay, so we've gotten through the House, it's got to pass through the Senate. All signals are that this is going to happen before the end of this week. Of course, we had a deadline of June 5th. Janet Yellen has been warning if we get on that deadline, we're going to be in trouble. So all indications are that this is going to be done by the end of this week and behind us. It's funny how they reference this debt deal, spending cuts and all of this kind of thing. This is a deal to spend money, essentially. So it's our budget over the next couple of years. The 314 to 117 vote relied on support from both Republicans and Democrats. Passage of the deal sends the measure to the Senate, where leaders have promised quick action, and Biden said he is eager to sign the measure into law. This is according to Wall Street Journal. Treasury Secretary Janet Yellen has said the government could run out of the cash by June 5th. As I just mentioned, the House vote marks the culmination of hard-fought debate in the chamber, where Republicans were intent on using the debt deal as leverage to deeply cut deficit spending and roll back many of the president's signature initiatives, but ended up settling for more modest changes. Okay, so this is essentially a deal to go ahead and spend the money that we need to spend to keep government running over the next 2 years. Okay, this is going to go into now 2025. So we have a budget of how we're going to spend money from now all the way through the current term of this presidency and into the beginning of 2025. This brings certainty to how much money we're going to spend as a country to the Fed. And the Fed's going to be on deck here. We're going to talk about that in just a second, right? It doesn't mean that they couldn't have some catastrophe and start printing money again. Of course, this is what we're supposed to spend. And we've seen, if nothing else, in the last 3 years, that we can find other ways outside of the budget to go ahead and pass bills and spend and print a whole bunch of money, COVID or see, wars and these types of things, right? That obviously, are going to impact inflation, right? If we stick to this budget of no new increases off of the last budget, then the signals are like, okay, this could be a decent thing. It's not at least we're not going to go into default here, and the dollar's not going to crash and all that kind of stuff. We've bought ourselves here through January 1st, 2025. So basically they'll be battling this thing out again, right after. It's going to go from like 2024, end of 24, new president is elected, and then this is going to be like the focus for the lame duck Congress to basically put a new deal together before January 1st. The deal trims some discretionary spending next fiscal year and imposes a 1% spending cap for fiscal 2025, but doesn't touch big parts of the budget, including Social Security and Medicare. It also has provisions to speed up energy projects and impose new requirements for food assistance. The legislation would reduce government deficits by about $1.5 trillion over a decade, compared with the baseline forecast, according to the Congressional Budget Office. Basically, we're going to spend on par, essentially, with what we've been spending. And that's, again, outside of all those special projects and special spending that they do. All right. So how does this impact housing? How's this going to impact the economy? We saw in the last, 24 hours, 48 hours, that the 10-year Treasury yield started to have more pressure downward, which has reduced that 30-year fix back under 7%. I expect that over the next week, as this thing gets ironed out, we're going to continue to see that downward pressure on the 10-year, which should bring the 30-year fix back down to where it was before all the drama, which was just under 6.5%, just under 3 weeks ago. Okay, so that's the biggest impact that we're going to have on housing. We talked about the home buying affordability yesterday. If you missed yesterday's hot sheet, you can go back and check that out. There were some pretty good charts in yesterday's daily download that cover that. And essentially, if we get back down to under 6.5% on the 30-year fix, we're not going to be, at an affordable rate that we saw a couple of years ago, but it's not going to be at this extreme pressure rate that we have every time we get over 7%. We saw mortgage applications drop this week. We talked about that yesterday. And, you'll continue to see mortgage applications drop if we sustain over 7%. You'll continue to see forecasters change their analysis if we sit up over 7% on where they think home values are going. Hopefully today, June 1st would be interesting. Hopefully today on June the 1st, with 7 months left in 2023, marks the death of the 7+% 30-year fixed interest rate. Hopefully today, moving forward, we can see the pressure downward and get back under 6.5% for the remainder of this spring buying season. And then hopefully we'll start to get on trend with where a lot of analysis is that we're going to get under or at 6% by the end of the year. So that will continue to trend downward on the 30-year fixed. We know home shoppers need that. We know that that's going to be important for any home shopping affordability. But it might all have to do with what Jerome Powell does next. He's on deck. The Fed is on deck. They're going to be the big talk here for the next couple of weeks as they plan to meet on June 13th for the next FOMC meeting. Now, a report this morning came out in the Wall Street Journal. This was kind of getting leaked out by one of the Wall Street Journal reporters last night on Twitter. Federal Reserve prepares to skip June rate rise, but hike later. Now, why they would do that, I don't know. It seems very odd. Why wouldn't you just pause and sustain a pause, or continue to hike, then pause, then cut? Why wouldn't you kind of do this all in order? But according to Nick Timiros, Federal Reserve officials signal that they are increasingly likely to hold interest rates steady at their June meeting before preparing to raise them again later in the summer. Okay, investors, a lot of times when you get a leak from especially this reporter at the Wall Street Journal, they tend to be true. Okay, so all indications are that over the next couple of weeks, with this report that just came out last night and into early this morning, that the market is now going to be pricing in a pause, not an expected hike like we had maybe just a couple of weeks ago. Investors in recent days had expected the Fed would lift rates at its meeting June 13th to 14th, prompting two policy makers Wednesday to publicly underscore their preference to forego a hike, barring a sizzling jobs report on Friday. So tomorrow we're going to get jobs report. Make sure that you're tuned in live at 9:30 a.m. We'll cover the whole thing, as we always do here on the Hot Sheet. Hit the thumbs up if you appreciate all of the live streams. The strategy would give. And by the way, just curious, in the comments, are you typically a replay or a live stream on the Hot Sheet here? And if you are replay, if you weren't aware, we do have the podcast available anywhere you listen. So if you like the replay, it is available on Apple and Spotify as well. All right, the strategy would give officials more time to study the economic effects of the Fed's 10 consecutive prior rate hikes, as well as recent banking stress, by spacing out further increases. They have lifted rates by 5 percentage points since March 2022 to combat high inflation, most recently to May 3rd to a range between 5 and 5.25%, obviously a 16-year high. Okay. Decision to hold our policy rate constant at coming meetings should not be interpreted to mean that we have reached the peak rate for this cycle. This is Fed Governor Philip Jefferson in a speech yesterday in Washington. Indeed, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. Now, we could, and here's where I think if they do pause, here's where I think we could start cutting without ever raising again. If we could just stay paused and wait for some of this lagging data in inflation called shelter, called the rental data that we know in real time here, like on the hot sheet, we know in real time rental data has cooled. It's not reflective in the data that the Fed takes into consideration. They use a very old survey. The survey started in the 1980s. They call people at their home and say, hey, what do you think your house going to rent for? Well, I don't know. I've lived here 30 years, but I guess I could get this number. And they throw some number against the wall, like they're taking their spaghetti off the dinner plate and just whipping it against the wall. And that's the number the Fed uses. Okay. So once this drops, Barry Sternlight, CEO of Starwood Capital, and others believe that the rents are already way down. Once this gets sucked out of inflation, we could see inflation drop significantly, and then they might have the data to say, whoa, okay, well, we paused, and now we could remain at this level for an extended period of time, or we could decide to start dropping. Anyways, all eyes are going to be on Fed Chair Jerome Powell, as he did lay the foundation, or this leak here, especially from Fed Governor Philip Jefferson, has laid the foundation that we should expect a pause June 13th to June 14th. We'll see how the markets react to that news. Okay, the markets right now in housing that are overvalued compared to undervalued, according to Moody's Analytic, Mark Zandi, chief economist Mark Zandi. Okay, how many of the markets right now in the U.S. are overvalued? Let's get into it. Back in May, Moody's Analytics had said that home values, back in March, so basically a year from now, March of 2022, second quarter of 2022, let's call it, Moody's Analytics estimated that the U.S. housing market overall was overvalued by 26.98%. That was above its housing era peak of 22.22%. In quarter four now of 2022, this was above the housing era peak of 22.2% in quarter four of 2022. Okay, so there you go. Far above the 2.17 overvaluation in quarter two of 2018. Okay, now where are we today? All right, the underlying fundamentals are already improving. Okay, for one thing, Zandi was right. The housing market did slip into a correction in the second half of 2022, right? We saw 7 months straight of month-over-month home price declines. Prices in frothy markets like Austin and Boise did fall around 10%. That was a prediction by Moody's. Home price declines in overheated markets coupled with rising household incomes also means that the spring 2023 market isn't overvalued as spring of 2022. So today's market, according to Moody's, according to Mark Zandi, are not as overvalued as in spring of 2022, but Moody's does still believe that many of these markets are overvalued. How many? An updated analysis by Moody's Analytics find that the U.S. housing market was overvalued by just 16.85%, so not over the 20% in the first quarter of 2023, nearly 10 percentage point improvement from quarter two of 2022. Even Boise, which was overvalued by 71.48% in quarter two of 2022, has seen an overvaluation level come down to 54.02%. I did see this tweet by Lance Lambert from Fortune. This is a Lance Lambert piece here that showed Boise's housing inventory. I don't have the chart, but anyways, Boise's housing inventory straight line up in the last month. So inventory just skyrocketed in Boise. Right now, the overvaluation has come down, but Boise is one of those markets that got way overheated during the pandemic. Okay. All right. So for the here's the deal. For the 404 largest housing markets in the US, Moody's believes that we have the majority of markets, 387, are overvalued. That includes 157 markets which Zandy calls significantly overvalued, meaning they are overvalued by over 25%. At the height of the boom in quarter two, 2022, 195 markets fell into that camp. Those markets, including places like Nashville, overvalued by 46.66%, Tampa overvalued by 37.56%, Austin overvalued by 36.62%, are the highest risk of home price declines currently. Keep in mind that just because the housing market is overvalued doesn't mean that home prices there will decline. Historically speaking, housing markets can remain overvalued for years. Like, think about Tampa, right? There's still an inbound flow of migration. So while Zandy and Moody's might say, hey, Tampa's overvalued, if people continue to vote with their feet, meaning they continue to migrate into a Tampa or a Southwest Florida, that market could remain its own little bubble for years, over an overvaluation for years, because the more demand, the more inbound migration that's coming into the market, especially in low inventory environment like we have today, the more we could see that market remain overvalued. Okay, I've got two charts here from Fortune, Lance Lambert charts that are sourcing Moody's Analytics to show the degree which 404 largest U.S. housing markets are overvalued or undervalued. You don't see many of that tannish, brownish color, which would be the undervalued market. Okay, you've got a Florida that's looking really dark, rich green in the overvalued camp. You've got really all of the Northeast looking overvalued. You've got all of the East Coast, Southeast section, all signaling overvalued. One of the undervalued spots would be California. It's got some of that brown coloring. Okay, you've got that chart, and then you've got another one here that kind of shows you going all the way back to 2022, the degree to which the 404 largest U.S. housing markets are overvalued or undervalued. And so we've peaked up at a higher rate than we saw back in that 2005 to 2007 range. And you can see that in that 2008 all the way until 2020, we really had no markets that were significantly considered overvalued until the money printing machine got out of control the last 3 years, and we saw these home values go up over 40% in the country, and in many markets even more than that. All right, those two charts are going to be down below for you in the daily download. If you sign up once for the daily download, you get all of those, but that might be coming to an end. And I'm sorry to keep the bad news here at the end of the show, but we're working on being able to categorize. I get a lot of questions. Hey, there was a chart a month ago. I can't find it in my email because I don't know which day it was. So we're working on categorizing this all in BAMX. So that's a reminder to make sure that if you haven't subscribed to BAMX yet, make sure you do that now. Make sure you go down and use the code HOTSHEET. That gets you 15% off of the annual subscription to BAMX. We have a private Facebook group, and this actually was a comment in that private Facebook group. Hey, I wish we had a categorization of all of the data that we're getting on the hot sheet somewhere. Well, we have the platform to do it. That's called BAMX. And so that might, all of the hot sheet daily downloads might be going there. So make sure that you subscribe, use the 15%. I don't know how long the 15% is going to last. It is the biggest discount of any of our other podcasts. All of our other podcasts are 10%. So why you wouldn't use the hot sheet discount is beyond me. Make sure you go and get that 15% off the annual subscription to BAMX. We'll keep our eye on, obviously, where the 30-year fix is going to go today after the news. Yesterday, obviously, we did have the 10-year continuing to drop, and we did have another little drop to 6.88 on the 30-year fixed. So there you go. Also, if you want me to get into, let me know in the comments, either on the live chat here or on the replay, if you want me to get into tomorrow specific markets, and we can do some live Q. We can do a little fun Friday show. We can do some live Q&A. If you want me to tomorrow to get into specific markets on the overvalued, undervalued chart here, we could click a whole bunch of these. Let's pick Charleston right now, and you can see how that changes. Okay, so if you'd like me to do that tomorrow, undervalued, overvalued games, say that. Hey, Friday, undervalued, overvalued. Let's pick specific markets. I'll take comments from all of you, and we can go through it. Until the Friday show tomorrow, have a great Thursday, and toodaloo.